Okay, we're going to continue on chapter 16 where we left off. So, the contribution margin is the difference between revenues and variable expenses. Okay, so contribution margin can be done on a dollar basis. It can also be done on a per unit basis. So we need to pay attention to whether or not you want to do a per unit basis or a total dollar basis. So the next one. So if you're calculating revenue in dollars for break even or for a specific target profit, when it's break even in dollars, you're going to take fixed cost divided by contribution margin ratio. I do sales revenue and just leave the formula like we had it before, which was fixed cost plus target profit, which is 0 at break even divided by contribution margin percentage. So we have 10,000 boards. Remember, under CVP, we assume that production and sales is the same. So selling price is 400. Variable cost per unit is 240. So contribution margin per unit is 400 minus the 240, which is 160. Total fixed cost, 1,200,000. So what is the contribution margin per unit? 400 minus the 240, which is 160. What is the contribution margin ratio? It's the contribution margin divided by the contribution margin per unit of 160 divided by the sales price of 400. Then we're going to calculate break-even sales revenue and the sales revenue needed for a target profit. Okay, so 160 contribution margin per unit. Contribution margin percentage is 40%. Break even in sales revenue, fixed cost of 1,200,000 divided by the contribution margin percentage of 0.40 is $3 million in sales. To get a target profit, in the numerator, you're adding your profit of 240,000. You're still dividing by the contribution margin ratio of 40%. To give you the 3,600,000. So we had sales of 120,000, variable cost of 48,000, operating income of 12. What is the break-even sales revenue? So you're going to take contribution margin in dollars, which is 120 minus the 48. And you're going to divide that by the sales dollars of 120,000. And what does that give you as the contribution margin percentage? Right here. So 60,000 is the contribution, total fixed cost is the 120 minus the 48 of variable minus the 12,000. So that fixed cost is 60,000. Remember, operating income is 12. So sales of 120 minus 48 gives you contribution margin minus fixed expenses is going to give you the operating income of 12. So contribution margin percentage is 0.60. It's the 120 minus the 48 gives you contribution margin in dollars divided by sales dollars gives you the 0.60. Break even is fixed expenses divided by the percentage, which will give you $100,000. So the number of units needed to generate an after-tax target profit, we are going to introduce two more variables. T, the tax rate, and N is after-tax income. So the after-tax income we want is $390,000. We want to convert this into a pre-tax income. Okay. So after tax divided by 1 minus the tax rate gives us the pre-tax income. So we have selling price of 400, direct materials, direct labor, and variable overhead. These three are all our variable costs per unit, and fixed cost is in dollars. Okay, so income before taxes is Z. Z minus your income taxes. You get the income taxes by taking Z times your tax rate, gives you your after-tax profit. Okay, so Z is equal times 1 minus T equals N. So N divided by the 1 minus T gives us Z. So we're going to do this off to the side to come up with Z, and then we'll plug Z into that formula, CVP formula. P minus V times Q minus F equals Z. So after-tax income divided by 1 minus the tax rate gives us a before-tax income of $650,000. So Q is fixed cost plus the target profit divided by contribution margin per unit, which is price minus variable cost per unit. So you're going to get 11,563, and that is rounded. So when you are doing these calculations, if you have a partial unit, even if it is 0.001, you always round up to the next number. Okay, but if you're going to use this Q to calculate PQ, you have to keep at least 5 decimal places to take care of rounding. So we had 11,563. We're going to prepare a contribution format income statement. Sales revenue minus variable expenses equals contribution margin minus fixed expenses gives us our operating income minus the income taxes, ends up giving us net income after taxes. It's a little bit larger because we rounded up the number of units that we had when we solved for Q. Okay, so rounding is the reason we're not exactly equal to 422,500. So how do income taxes affect the break-even point and CVP analysis? Okay, so it doesn't affect the break-even point because break-even is before tax. It does affect the number of units because you're going to have to subtract from operating income your taxes to get after tax profit. Okay, so the basic CVP formula looks at before tax profit, operating income minus income taxes gives you your after tax profit. So in the behavioral format of the income statement, fixed expenses can be separated between direct and common. Okay, direct fixed expenses can be traced to each segment. And so they are avoidable if the segment did not exist. So in a segmented income statement, you will have sales revenue minus variable expenses equals contribution margin minus direct fixed expenses equals segment margin. You would have that for the 2 or 3 segments. And then in the total company column, you would subtract from total segment margin of all the segments minus common fixed expenses to give you bottom line net income. They're called common because they're not traceable to the segments. Okay, we are not going to be doing multi-product CVP analysis, but it does exist. You have to look at the sales mix. So how much are we making of product A versus product B, and what the contribution margin is for each of those different products. So this shows you what to do, but we will not be doing this from a testing perspective. Okay. So break-even point in sales revenue, you're going to use the assumed sales mix, and you can do it with multi-products. Again, we are not doing multi-product break-even or target sales. Okay. How does the sales mix change a company's break-even point? It will change the contribution margin of the package, and therefore it changes the units needed to break even. So, graphing CVP relationships, okay? You have a total revenue line and you have a total cost line. So, you're looking at the difference between profits and sales volume. Remember, operating profit is sales revenue minus your variable expenses minus your fixed cost. Operating income is the dependent variable. Units, our Q, is the independent variable. So here is our profit line. When we cross the x-axis, that is your break-even point. Zero profit. That's how many units you must sell to earn a profit, to have no profit. After this, each unit contributes toward covering the fixed cost and providing a profit. Okay. So this is where we're looking at the revenue line and the cost line. So here is total revenue. Here is total cost. Where cost equals revenue, that is your break-even point. It's another way of showing the CVP graphing, using the profit and the cost, well, the revenue line and the cost line, and it shows you what the profit is, which is this green area right here. Okay. Assumptions of cost, volume, profit analysis. This would be a fairly common theory or concept question. You assume that both revenue and cost can be expressed in a linear way. Okay. Price, total fixed cost, and unit variable costs can be identified and are constant over the relevant range. This is another assumption. I've talked about it earlier. What is produced is sold. For multi-product analysis, You assume you can figure out the sales mix. And then you assume the selling price and cost can be assumed or assumed to be known with certainty. So you're pretty sure that the numbers you came up with are accurate. So risk and uncertainty in CVP. So future prices are uncertain because it depends on supply and demand. So what you were charging in the past may not be what you're charging in the future. There was a shortage of housing in the city of Houston. So people were able to sell their houses above the asking price. There were bidding wars because of the difference between supply and demand. So remember that you are anticipating what the future prices and cost are and the amount that's going to be on demand or that you can produce. Prices and costs have changed drastically because of the issues we're having with getting products to the buyers. So you might want to consider a break-even band instead of a break-even point. So a range for break-even, that's what they're talking about. You want to do sensitivity or what-if analyses. That's what CVP is all about. What if I change the selling price to this? What is my break-even point now? What if my variable cost changes by this? Now what is my break-even point? What if I reduce my fixed cost? What is my break-even point now? CVP analysis can be used when you're doing all the detailed budgets that we did not talk about in Chapter 8. So you're doing what if. Remember, top management always wants to improve profit. You can improve bottom line profit by either increasing the sales price, increasing sales units, decreasing costs, both variable and fixed. Okay. So measurements of risk, 2 new formulas we need to know: margin of safety and operating leverage. So margin of safety is how many units or sales dollars you are above break-even point. Okay, so as long as margin of safety is positive, you are operating above break-even, which is good. If margin of safety is a negative number, if it is negative, then that means you're already operating below break-even. Okay. Then operating leverage, it looks at the fixed costs. Okay. The greater the degree of operating leverage, the more that changes in sales activity will affect profits. We are going to calculate degree of operating leverage. So it's the contribution margin in dollars divided by profit. So if a problem is asking you to calculate degree of operating leverage, typically you will have to first calculate contribution margin. That will be based on actual sales units or budgeted sales units. Okay, so sensitivity analysis, what if? Try changing one of those variables. We have 5 variables: selling price per unit, variable cost per unit, units sold. Remember, we're assuming production and sales are the same, total fixed cost, and a target profit. So the reason I prefer the formula the way I set it up is you can be changing any of those 4 variables. You're given 4 out of the 5 and you solve for the 5th one, and that's where you end up doing that sensitivity analysis. So margin of safety is the sales activity that's needed, that's in excess of the break-even point. So it is a formula. The formula for margin of safety is actual or budgeted sales minus break-even sales. Margin of safety, which is commonly abbreviated either MOS, all caps, or MS, is equal to actual or budgeted sales minus break-even sales. You can calculate it in units and dollars or as a percentage. If the number is negative, then you are operating or budgeting to operate below break-even. Then operating leverage, you need to know that formula. It's how fixed costs are used to help generate profits. So as the margin of safety goes up, risk decreases, okay? And it increases leverage risk. So non-unit cost drivers using ABC. Remember, we are using different ways of applying overhead, but you still have to come up with a cost associated with applying the overhead that will be part of the variable cost, okay? So it's going to be total revenue minus fixed cost plus the variable cost plus the setup variable product cost here plus the setup cost, the engineering, okay? So non-profit entities may also use CVP analysis. So nonprofit would be like United Way. How many dollars must we be able to collect to be able to cover all of our costs? So why does activity-based costing approach to CVP offer more insight than the conventional approach? And that is because overhead is not necessarily based on a unit level of activity, which is number of units, direct labor hours, machine hours, direct labor cost, direct materials cost. Those are the unit level activities. Okay, so you can calculate break even in units or in dollars. You can solve for units and then multiply by P to get sales dollars, or you can calculate sales dollars directly by taking fixed costs divided by contribution margin percentage. You can use after-tax target profit, convert it to a before-tax profit, and then plug it into the CVP formula. We're not doing multi-products. There are 2 ways of doing the profit volume graph or the cost volume profit graph of graphing CVP analysis. And we have margin of safety and a degree of operating leverage, okay? So let's stop the video there. Okay, now we're going to start up and we're going to go to the problem shelves. So this is where we left off. Brief exercise 16.3. So this is a service organization. They provide temporary nurses. They're thinking they need 23,500 hours will be needed. They charge $90 an hour, has variable cost of $75.60 per hour, which includes the salary of the nurse, and total fixed cost are $321. Calculate the contribution margin per unit and contribution margin ratio. So P is $90. V is the $75.60. Q, we're not looking for that yet. F is 321,000. Okay. So the contribution margin per unit is $90 minus the variable cost per unit of $75.60. Gives you a contribution margin per unit of $14.40. Then the contribution margin ratio, this is the formula. P of 90 minus V of 75.60 divided by the $90 gives us the contribution margin percentage of 0.16 or 16%. Calculate the sales revenue needed to break even. So this is the formula for calculating revenue directly. So that's going to be 0 plus 321,000 divided by 0.16. And that's going to give us a large number, 2,006,250,000. Okay. So part 3, calculate sales revenue needed to achieve a target profit of 100,000. So Z is 100,000 plus F of 321,000 divided by 0.16. And that is going to give us a larger number, 2,631,250. What if the operating income is 110,000? Would sales revenue be larger or smaller? It would be larger because profit is going up by $10,000. Okay, so since profit increases by 10,000, the sales revenue must increase. Okay, so we're going to take 10,000 increase divided by 0.16, and that's going to give us $62,500 increase in profit. Okay. So when we're looking at after-tax profit, we want to add these two new variables. T is the tax rate, N is after-tax profit. You want to off to the side, calculate what Z needs to be and substitute that in the basic CVP formula. Okay, so we're going to do brief exercise 16.4. They want an after-tax profit of $420,000. So let's just plug in all these numbers. 275 is the selling price. V is 90 plus 65 plus 16 plus 14. It's going to give us 185. Common mistake students make. They forget that direct materials and direct labor are variable. Okay. Then your fixed costs is 440,000 plus fixed selling and admin of 290,000. And that's going to give us 730,000. Tax rate is 0.40. And the after-tax profit is 420,000. Okay, so we're going to convert the N into Z. So N is 420,000 divided by 1 minus 0.40. So that's 420,000 divided by 0.60. And that's going to give us 700,000. Now, a common mistake that students make with this is instead of dividing by 1 minus the tax rate, they end up dividing by the tax rate. So the Z ends up being calculated incorrectly. Okay. So calculate the number of units that will yield operating income of 700,000. So we're going to do P is 275 minus V of 185 times Q minus F of 730,000 equals Z of 700,000. Okay. So going to get 90 Q is equal to 1,430,000. So Q is equal to 1,430,000 divided by 90, which will give me 15,888. Okay, or 15,889. Now, what if they wanted PQ? So P was 275. Times Q of 15,888.88889. And that gives you 4,369,444. Okay. Or contribution margin percentage equals, what is it, 90? 275 minus 185 divided by 275 equals 0.32727. So PQ is equal to, Z was 700,000 plus F of 730,000 divided by 0.32727. That is 4,369,481. Okay, we're off what, $37, and that's because of rounding. We did rounding here, and we also did rounding up here. Okay. Then prepare the income statement for the year. You're going to simply plug the numbers in. This one would be 275. You're going to use the rounded number here, which is 15,889. Okay, and you'll plug all the numbers in here. Then, what if they had a 35% tax rate? Would the units sold reach 420,000? Is the tax rate higher? What did it go to? 40. Be higher or lower than what was calculated in number 3? It would be lower because less money was going to taxes. We're going from a 40% tax rate to a 35% tax rate. So less money is going to taxes. Okay. Then here is the formula for degree of operating leverage. Again, many problems are going to make you calculate the contribution margin and net income. Margin of safety, it's either actual or budgeted sales. You don't know which one it is. Depends on how the data is given to you, minus the break-even sales. This could be in dollars or in units. And then to get margin of safety percentage, it's the margin of safety in dollars divided by sales dollars, or margin of safety in units divided by sales units. Okay. Then here is another formula that you need to know that was not given to you in the PowerPoint. If there is no change in costs, then the change in net income is equal to the change in sales dollars times contribution margin percentage. Or if they give you the change in sales units, you're going to multiply by contribution margin per unit, or the percent change in net income is equal to the degree of operating leverage times the percent change in sales. So this is the formula for margin of safety percentage. How does a change in sales units or dollars affect net income? And how does a percent change in sales affect the percent change in net income? Okay, so we're going to do brief exercise 14.6. All right, P is 0.08. V is 0.015 plus 0.004 plus 0.001, which equals to 0.02. There is no variable selling. Okay. Fixed selling are 46,000. So total fixed cost is 80,000 plus the 46,000. That is equal to 126,000. Okay. Solve for Q. P of 0.08 minus B of 0.02 times Q minus F of 126,000 equals 0. Let's see if I can bring this up any. So 0.06 Q is equal to 126,000. So Q is equal to 126,000 divided by 0.06. And that should give you 2,100,000. Okay. Then calculate break even in sales dollars. So first we need to calculate contribution margin percentage, which is going to be 0.08 minus 0.02 divided by 0.08. And that should equal to 0.75. So PQ is break even, yes, 0 plus 126,000 divided by 0.75, and that equals 168,000. And you could have gotten the same thing if you had done 0.08 times 2,100,000. It's also going to give you 168,000. Okay. Now, sometimes you can't use this formula because of the way they gave you the data. You have to be able to use this formula. So you need to have that one memorized for your exam, your final. Then calculate the margin of safety in units. So actual sales, 2,800,000. That's the actual or budgeted. So that's 2,800,000 minus break even of 2,100,000. So margin of safety is 700,000. So the meaning of margin of safety is how much sales can go down before you show a loss. Okay. So margin of safety in dollars. Actual or budgeted sales is 0.08 times 2 million, what? 800,000 minus break even of 168,000. And that should give you 56,000. Or you could have done 700 units times the selling price per unit of 0.08, and that would also give you the sales dollars. So what if the total selling and administrative expenses are reduced to 38,800? Calculate a new break even. So P is 0.08 minus 0.02 times Q minus 38,800 equals 0. Okay. So that is 0.06 Q is equal to 38,800. Oh, do we have some expenses before? Oh, yes, should be 80,000 plus. So that is 118,800. So Q is equal to 118,800 divided by 0.06 should give us 1,980,000. Break even will go down because fixed expenses went down. Okay. And break-even point in sales revenue, it should be 0 plus 118,800 divided by, what was it? 0.75. And that's going to give you 158 for 400. Okay. So break even goes down in sales dollars because fixed cost went down. Then what is margin of safety for the coming year? In units. So what did we say it was? 1,980,000 was the break even. So we had 2,800,000 minus 1,980,000, which would give us 820,000. Since break even went down, margin of safety goes up. Okay. Then in sales dollars, you could do it this way. 820,000 times 0.08 equals 65,600. So the break even in dollars goes up from 56,000 to 65,000. Okay, 16.8. Contribution margin for 1 unit. So let's see. Price is $19. Variable cost per unit, $9.20. They gave it all to us. F is 104,860. Contribution margin, $19. Subtract the $9.20 to give us $9.80. How many units have to be sold to break even? So we're going to do 19 minus $9.20 times Q minus 104,860, 104,860 for fixed cost equals 0 profit. Because break even, it's 0. Okay. So you're going to get 9.80 Q is equal to 104,860. So Q is equal to 104,860 divided by 9.80. And that's going to give us 10,700. Okay. So if they sell 13,000, what is the operating income? We're just going to plug the numbers in here. So $19 minus 9.20 times 13,000 minus F of 104,860 equals Z. So this time we're solving for Z. So we're going to get 1 27,400 minus 104,860 gives us a profit of 22,540. So calculate the margin of safety in units and in sales revenue if 13,000 skins were sold. So actual was 13,000. Break even, back up here, 10,700. So margin of safety in units is 2,300. And in dollars, yeah, 13,000 times $19 minus, do we calculate it? PQ, we didn't do PQ, did we? No. Minus 10,700 times 19. And that's going to give us 43,700. Or I could have taken the 2,300 and multiplied it times the $19. Okay, 1610. P is 22. V is per unit. Going to have to calculate 1,086,800. That is for 130,000 units. It's going to give us 8.36. F, 8 million. Wow, that's a lot. So the contribution margin is going to be $22 minus $8.36, which will give us $13.64. Contribution margin ratio, 22 minus 8.36 divided by $22. Going to give us 0.62. Now, I am starting over from scratch. I could have taken contribution margin of 1364 and divided by 22, but I started over from scratch because a problem may not ask me to calculate contribution margin per unit first. So that's the reason why I'm starting over from scratch. Okay. Sales revenue needed to break even. So Z is 0 plus F of 8 million. Is that right? Yeah, 8 million. Divided by 0.62. equals $12,903,225. 12,903,225. Okay. Then we wanted a target profit of 245,000. That is, Z is 245,000 plus F of 8 million divided by 0.62 equals 13,298,387. So it's going to be more dollars because my profit is going from 0 to 245,000. Okay. Sports reps had revenue of 12 million, variable cost of 5,678, and fixed cost. What is the contribution margin ratio? Okay, on this one, we had to use dollars. So PQ, whoops, PQ minus VQ divided by PQ. Okay, so it's going to be revenue of 12,345,000 minus variable expenses of 5,678,000 divided by the 12,345,000. Okay. And that should give us 0.54. So in this one, we had to do it on a dollar basis because we did not get P and V separately on a per unit basis. So we had to use the dollar basis. So break even in sales dollars is equal to 0 plus for the fixed expenses, 2,192,400, 2,092,000 divided by what did I get? 54 equals 4,060,000. Okay, then margin of safety. $1,345,000, 12,345,000 minus 4,060,000 equals 8,285,000 even. Okay. They're proposing a film that should increase revenue by 230,000 per year. And the cost associated with it is 122,500. So is this a good idea? So increased contribution margin is equal to 230,000 times, what's the contribution margin percentage? 0.54. So that's the increased revenue. Minus increase fixed costs of 122,500 equals 1,700 increase in profit. So yes, it is a good idea. Okay. So for this one, you cannot look at just the revenue. You have to look at the contribution margin. Okay. Don't look just at the increase in revenue, but the increase in contribution margin. And then we are not doing multi-product. CVP analysis. Okay, so that takes you through all the problems that you will be expected to do. We didn't do a degree of operating leverage, but when we do the review for the exam, we will have a problem that includes a degree of operating leverage. So the next video will be covering the review for the final exam. The final exam is a small portion of Chapter 8, Chapter 9, Chapter 10, and Chapter 16. So we've covered all of Chapter 16. That is the content for the semester. We've covered everything we were supposed to cover. Okay. So the next video will be the review for the final, covering 8, 9, 10, and 16. So thank you for being here today. Thank you for meeting me a little bit late because of my meeting that we had here. I appreciate it. I do need you to fill out evaluations. So if you would please, you should have gotten an email from the college about evaluations. We use the results of those evaluations for our accreditation. And we get reaccredited every 5 years for accounting because we are accredited by AACSB in addition to the university accreditation that we have. So if you would please do the evaluations, and that is the semester. All we have is one more class, which is the review, and then your exam is on Monday during your class time. It's the same format, so it will be only a 2-hour exam. So do y'all have any questions for me? Okay, that's it for today then. Thank you all for being here. Stay safe, stay healthy, and pray for rain. Take care. Bye.
Professor.